As I noted earlier, today's decision to raise the federal funds rate is another step in the process of gradually scaling back monetary policy accommodation as the economic expansion continues. This gradual process has been underway for more than 2 years, and it has served and should continue to serve the economy well. In making our policy decisions over the next few years, we will continue to aim for inflation of 2% while sustaining the economic expansion and a strong labor market. In the committee's view, further gradual increases in the federal funds rate will best promote these goals. By contrast, raising rates too slowly would raise the risk that monetary policy would need to tighten abruptly down the road, which could jeopardize the economic expansion. At the same time, we want to avoid inflation running persistently below our objective, which could leave us with less scope to counter an economic downturn in the future. Participants' projections of the appropriate path for the federal funds rate reflect our gradual approach. The median projection for the federal funds rate is 2.1% at the end of this year, 2.9% at the end of 2019, and 3.4% at the end of 2020. By 2020, the median federal funds rate is modestly above its estimated longer-run trend. Most participants revised up their projections since December, although the median projection for this year did not change. The medians for 2019 and 2020 are somewhat higher than in December. Of course, we'll be watching how the economy evolves in the months and years ahead relative to our maximum employment and price stability objectives. If the outlook changes, we will adjust monetary policy appropriately. Finally, I'll note that our program for reducing our balance sheet, which began in October, is proceeding smoothly. Barring a very significant and unexpected weakening in the outlook, we do not intend to alter this program. As we've said, changing the target range for the federal funds rate is our primary means of adjusting the stance of monetary policy. As always, the committee would be prepared to use its full range of tools if future economic conditions were to warrant a more accommodative monetary policy than can be achieved solely by reducing the federal funds rate.